All right, let's unpack this. Imagine you're just buried under financial information.
Yeah.
Every second, there's more data, stock prices moving, economic reports, news, company stuff flooding in. How does anyone, like a financial analyst, even start to make sense of it all?
It's a lot.
How do they decide if something, a stock or a bond is a buy or a sell or just hold?
It's like drinking from multiple fire hoses, really. You've got market data, economic numbers, company financials, industry reports, even just the chart patterns, historical prices.
Hmm.
It's impossible to process raw. You need a system. Analysts absolutely rely on structured approaches, sort of like a map for that flood of data.
Right, and they use different maps, different ways of looking at it. So our mission today in this deep dive, using these notes on security analysis, is to give you that map.
Yeah.
To understand the main ways analysts evaluate securities, cut through that noise, and figure out, what they're looking at and why.
And we'll really focus on the two main schools of thought in the material: fundamental analysis and technical analysis. Their methods are, well, pretty different.
But the goal's the same.
Ultimately, yeah. Determine a security's value, make informed recommendations, buy, sell, hold. But how they get there, that reveals a lot about what they believe drives the market.
Okay, so let's start basic. What's the absolute core goal of security analysis?
Simply put, determine the value of a security stock, bond, whatever, and use that to recommend an action.
Is it priced right? Too high? Too low?
Exactly. Should you buy it, sell it, or just sit tight?
And getting that value means looking at, well, everything, seems like. The source lists, market data, economic stuff, charts, industry details, company numbers.
It's a huge data set. Market data, economic data, charts, industry specifics, company data, financial stats.
Yep.
That abundance is both the fuel and the challenge. You need structure. You can't just glance at a price. You have to know how to analyze it all. And, crucially, how to interpret the results to make a solid recommendation. That interpretation turns data into actual insight.
Got it. Which brings us to that big split, fundamental versus technical analysis. The notes lay out some clear differences.
They really do. They're almost philosophical opposites about what drives prices. Let's walk through those key distinctions from the source.
All right. Definitions first. Fundamental analysis is about assessing prospects' industry, company short, medium, long term, looking at the business itself.
And technical analysis, that's studying historical prices and market behavior, looking at the price action, how the market has moved.
Okay. And their primary goals. Fundamental aims to measure intrinsic value. What should it really be worth based on economics, industry, the company's performance?
While technical analysis tries to determine future price direction, where's the price likely heading next? Based on past moves, sentiment. Less about inherent worth, more about trajectory.
So, focus of study. Fundamental looks at the causes of price moves, profitability, economic shifts, why the price is changing.
Right, because something fundamental about the value is shifting. Technical studies the effects of supply and demand. How does it show up? Price, volume. They study those indicators directly.
Regardless of why supply or demand changed.
Pretty much. The why is less important than what the price and volume are actually doing.
And key considerations. Fundamental analysts are digging into macro factors, industry stuff, and crucially, the source says, the issuer's profitability. Actual or expected.
Can they make money? Pay debts? Pay dividends? That's central.
Technical analysts focus on chart patterns, sentiment, investor psychology, how the crowd is behaving, basically, as seen in the data.
Exactly. Which leads to their core beliefs. Fundamentalists think price should reflect underlying value, a big gap, mispricing, opportunity. Technical analysts believe past patterns repeat because investor psychology, fear, greed, hope tends to be repetitive. They think those patterns on charts offer predictive clues.
And the source notes that fundamental analysis, while highlighted for stocks here, applies broadly to bonds, other securities too.
Absolutely. And things like profitability ratios, even though covered later in detail, are critical for fundamental analysis, whether you're valuing a stock or checking if a company can handle its bond payments.
That financial health is the bedrock.
It really is.
Okay, let's dive deeper into fundamental analysis. When an analyst does this, what are they trying to figure out specifically?
Their main aim: evaluate a whole range of conditions. Capital markets, the economy, domestic, and global, the industry, the specific company.
Pulling it all together.
Right, to find the security's intrinsic value or fundamental value. Think of it as what the company is really worth, based on assets, earnings potential, future prospects.
And once they have that number,
Yeah,
that intrinsic value.
they compare it to the current market price.
Mhm.
If their estimate is way higher than the market price, they see it as undervalued, maybe a buy.
And if the market price is higher,
Then it looks overvalued, possibly a sell signal.
so the scope is huge. You mentioned macro factors like the outlook for trading partners.
Hmm.
Why does something happening globally matter for a local stock?
Because we're in a global economy now. If a major trading partner slows down, well, that could hit demand for exports.
Right.
Or if commodity prices rise globally, that impacts costs. These big trends affect revenues, costs, which directly hits expected profitability, and that changes the intrinsic value calculation.
So it's a whole environment, not just the company. And industrial factors like the stage of growth.
Exactly. Is it a brand new, risky industry, growing like crazy,
Huh?
or mature, stable? That context is vital for judging potential.
And again, the source stresses the most critical factor is the actual or expected profitability of the issuer.
Yes, this is the heart. All those macro industry factors, they ultimately funnel down to how they affect the company's ability to make money, now and later.
Profitability ratios are just tools for that.
Tools to measure that ability, yeah. Can it generate earnings, pay dividends, reinvest, cover debt? Without profits, long-term value just isn't there.
Okay, switching gears. Technical analysis. If fundamental is about value from causes, technical is forecasting price from effects.
You got it. The core aim is forecasting future price moves based only on past price and volume. They're not usually digging into earnings reports or economic forecasts directly.
And they believe you can read market sentiment just from charts.
That's the idea. They believe collective behavior, fear, greed, reactions shows up in price and volume patterns. And since human psychology is kind of consistent,
Patterns repeat.
they tend to repeat, yeah. So identifying those patterns gives them a sense, they believe, of what the market might do next.
And markets can get wild. The source mentions news and uncertainty causing rapid, sometimes irrational moves. Mass psychology.
Oh, absolutely. Think about sudden bad news. Fear spreads like wildfire. Panic selling pushes prices down way faster, maybe way further than fundamentals would justify.
Or good news causing a buying frenzy.
Right. Greed kicks in. Technical analysts see those emotional bursts and sharp moves, certain chart patterns.
And now we have modern trading tech. Computers, high-frequency trading.
Adds another layer, doesn't it? These systems trade incredibly fast based on algorithms, sometimes reacting to each other or tiny price moves in ways that cause huge, sudden swings.
Swings that might have nothing to do with fundamentals. Or even human psychology.
Sometimes, yeah. It could be unintentional, just the machines interacting in unexpected ways.
The examples in the source really drive this home. The 2008-2009 crisis. A fundamental problem causing a massive market collapse, like 50% down.
That's right. And it wasn't just the troubled companies. Fear dragged everything down. Even healthy stocks got hammered. The technical picture was just collapse. Driven by fundamentals, but amplified by psychology and sheer selling pressure. The recovery took years.
Until 2013 or so.
Yeah. And the May 2010 flash crash, totally different animal.
The Dow dropping 600 points in minutes, then bouncing back almost as fast.
Wild. And many argue high-frequency trading played a big role, maybe even caused it, or at least made it much worse. It's a stark example of how automated systems can create technical price moves disconnected from, well, anything else.
Really shows how complex the market is. Why analysts might need different tools.
Definitely. Which brings us to market theories. These are models trying to explain why prices act the way they do. The source presents three, generally leaning towards markets being efficient.
Efficient meaning prices quickly reflect all info, best estimate of true value.
That's the idea. And the big implication, it's really, really hard to consistently beat the market if it's efficient.
Okay, first theory. Efficient market hypothesis, EMH.
Assumes rational, profit-seeking investors react fast to new info. Conclusion. A stock's price fully reflects all available information. It is the best estimate of true value at that moment.
Then random walk theory.
Assumption here. New info arrives randomly. Since prices react to info, price changes are random, unrelated to past changes.
Conclusion. Past price moves tell you nothing about the future.
Correct. Yesterday's news is already baked into today's price. The next move depends on new, random information, so history is useless for prediction.
And rational expectations hypothesis. Assumes people are rational, have all the info, use it smartly.
Use it for their self-interest. Make informed decisions. The conclusion. We can learn from past mistakes. By using available info intelligently, investors can anticipate change. It's a more forward-looking, rational view.
Now, EMH has different flavors, right? based on what info's priced in. And this matters for our analysts.
Hugely important distinction. The weak form says prices reflect all past market info, old prices, volume data. If true, anything a technical analyst studies purely from past charts is already reflected, making technical analysis kind of useless.
Okay, then the semi-strong form.
Goes further. Prices reflect all publicly available information. Past market data, yes, but also earnings reports, news, economic data, everything public. If this is true,
Then fundamental analysis is useless too, because the news is already priced in by the time you analyze it.
that's the implication. It suggests both fundamental and technical analysis might have little value for generating excess returns.
Wow. And the strong form.
The most extreme. Prices reflect all information, public and private, insider info. If this were perfectly true.
Nobody has an edge, not even insiders.
Right. No investor could consistently profit from having better information.
So these theories, especially the stronger EMH forms, suggest maybe all that analysis work is pointless if the market's already figured it out instantly.
That's the logical conclusion, yeah. However, the source does point out that studies do find evidence of market inefficiencies. The market isn't always perfectly efficient.
And why not? What causes those inefficiencies?
Several reasons are mentioned. Information doesn't hit everyone at the same time. People react differently to the same news. Not everyone can make perfect forecasts or valuations. And maybe the biggest one, mass psychology herd behavior, greed, fear, can push prices away from rational levels, creating mispricings.
So thinking about this as an investor, if you believe strongly in EMH,
It points you towards a passive approach. Buy and hold. Index funds, ETFs. Just own the market, accept the market return. Why try to beat something that's already perfectly priced?
but if you believe in those inefficiencies, if you think you can find mispricings,
Then you're likely to lean towards an active approach. More trading. Trying to pick winners. Time the market using analysis, believing you can outperform the average. Your view on efficiency really shapes your whole investment philosophy.
fascinating how theory connects to real-world decisions.
Absolutely.
Okay, let's circle back to fundamental analysis. Digging into those macroeconomic factors, how does something like government policy actually ripple through to stock values?
Macro factors really set the overall economic weather. And that weather hugely impacts investor expectations and security prices. The source groups them neatly. Fiscal policy, monetary policy, inflation, and then those unpredictable wildcards, crises, elections, tech breakthroughs, defaults, commodity swings.
Let's tackle fiscal policy first, government spending and taxes.
Right. Announced in budgets, these directly influence economic activity and, importantly, corporate profits. Take tax changes, higher sales or income taxes.
Less money for people to spend.
Exactly. Lower disposable income, less consumer spending, hurts lots of businesses. Tax cuts, potentially the opposite effect.
And corporate taxes.
Higher corporate taxes mean less profit left over. Less for dividends, less for reinvestment. Lower taxes can incentivize expansion. The catch with fiscal policy, though, is often the lag time.
Takes time to implement and see effects.
Yeah, takes time for laws to pass, money to get spent, for the economy to really react.
What about direct government spending itself?
More spending generally stimulates the economy, short term at least. Cutbacks slow things down. Expansionary policy often means both tax cuts and more spending to boost growth. Governments also use targeted policies, incentives for housing, say, or specific tech sectors. And policies designed to encourage investment, like dividend tax credits, capital gains breaks, RFSPs, TFSAs here in Canada. They aim to boost the amount of capital available for investment.
And government debt. How does that fit the picture?
High debt levels can be a real constraint. It limits policy options, fiscal and monetary. If the government owes a lot, it's harder to borrow more for stimulus or cut rates aggressively if debt servicing costs are high. It can also affect interest rates economy-wide, potentially slow growth, and weigh on stock valuations. Expansionary fiscal policy is just harder to pull off when you're already deep in debt.
Okay, next, macro lever. Monetary policy. Central banks, like the Bank of Canada.
Their main job, promote Canada's economic and financial well-being, primarily by keeping inflation low, stable, predictable, preserving the dollar's value.
And their key tool is interest rates.
Managing short-term interest rates, yes. Economy overheating, inflation rising. The bank might raise short-term rates, makes borrowing pricier, aims to cool down money and credit growth.
Economy slowing down.
They might lower rates. Cheaper borrowing, hopefully encouraging spending and investment.
And the source stresses these changes impacting interest rates and corporate profit are maybe the most crucial factors for security prices.
They're absolutely critical. Interest rates affect a company's cost of borrowing, and they're a key input in valuation models like discounted cash flow. Higher rates generally mean lower valuations, all else equal.
Lower rates, higher valuation.
Right. And corporate profits are directly tied to the economic activity influenced by these monetary policies.
Bond yields react too, right?
Yeah.
Faster growth pushes yields up. And the bank hiking short rates can do funny things to the yield curve.
Yeah, the tilting yield curve. If the bank hikes short rates to fight inflation, you might expect all rates to rise. But sometimes, long-term bond yields might actually fall.
Why?
If investors believe the bank's action will successfully curb inflation and lead to lower future interest rates down the road, the market anticipates future easing, so the curve tilts. Long rates end up lower than short rates. It's the bond market signaling its expectations. Very forward-looking.
Okay, last big macro factor, inflation itself. Generally bad news for stocks.
Typically, yeah. Inflation creates uncertainty, lowers confidence, usually pushes interest rates higher, and tends to squeeze corporate profits and lower those PE multiples we talked about.
How does it hurt businesses directly?
Higher costs. Raw materials, inventory, labor, everything costs more. Companies try to pass those costs on with higher prices.
But customers might resist?
Exactly. Buyer resistance can squeeze profit margins. Lower margins mean lower earnings, which puts pressure on share prices.
And that price earnings, PE, multiple link, the inverse relationship.
A very clear one. Remember, PE is what investors pay today for $1 of future earnings. High inflation means future money is worth less.
So future earnings are worth less today?
Right, they get discounted back more heavily.
Yeah.
So investors are only willing to pay a lower price for those future earnings when inflation is high. Higher inflation generally means lower PE multiples, hurting stock valuations, even if current earnings seem okay.
Makes sense. The future value just gets eroded. Okay, moving from the big picture macro stuff within fundamental analysis, let's talk industry analysis. Why is the industry structure so important?
Often the structure of the industry, the competitive landscape, has a bigger impact on long-term profitability and growth than almost anything else. Sometimes even more than the specific product.
Really?
Yeah, it affects growth potential, how volatile sales and earnings might be, and therefore how investors value companies within that industry. Some industries are just structurally more profitable or stable than others.
The source mentions classifying by product or service, like autos, and that structured system, GICS.
The Global Industry Classification Standard, widely used. It's hierarchical. 11 sectors, then 25 industry groups, 74 industries, 163 sub-industries, lets you compare apples to apple.
Like comparing Ford and Toyota.
Exactly. Great for single-focus companies, like Barrick Gold and mining, harder for giant, diversified companies that operate across many different classifications. You almost have to analyze their different parts separately.
Another classification, industry life cycle. Industries go through stages.
It's a theoretical model, yeah. Emerging growth, mature, and declining. Helps understand typical sales, pricing, cost dynamics. The length of each stage varies hugely, though.
Stage 1, emerging growth.
Brand new industries, often tech-driven, meeting new needs. Think early software, biotech, characteristics, often unprofitable initially, huge startup costs, maybe negative cash flow. Survival is very uncertain, many fail. Access for typical equity investors might be limited, often private companies or parts of larger firms.
Then the growth stage.
This is the rapid expansion phase. Sales, earnings grow much faster than the overall economy. These are growth companies. Their stocks are growth stocks.
Yeah.
Key features: above average returns on capital, rising sales volume, often tight cost control as they scale.
What's happening competitively?
The survivors get more efficient, lower costs, demand is strong, but competition heats up too. Profit growth is high, but cash flow might still be negative if they're reinvesting everything into growth.
And growth stocks. High PEs, low dividends.
Typically, yeah. High PEs reflect those high expectations. Low dividends because they're plowing earnings back into the business. The big risk: if growth disappoints, those high-flying stock prices can crash hard.
After growth comes mature.
Growth slows, stabilizes. Track the overall economy more closely. Companies usually have predictable, positive earnings and cash flow. Harder to differentiate products, so price competition increases, margins might get squeezed. Some companies diversify to find new growth. Stocks, often more resilient in recessions. Companies usually financially strong.
And finally, declining industries.
Growth stops, shrinks, maybe technology change, intense competition, shifting tastes. Think landline phones versus mobile. Characteristics might still generate decent cash flow because they're not investing in new stuff. but profits are often low or falling.
Okay, next framework. Classifying by competitive forces, Porter's 5 forces. How does this help?
Porter's model helps assess an industry's fundamental attractiveness, its long-term profit potential, by looking at 5 key pressures. 1. Threat of new entry. How easy is it for new competitors to jump in? High barriers like big capital needs, economies of scale, tough regulations, strong brands protect existing players' profits.
2. Competitive rivalry. How fierce is the fight among existing companies? Lots of players. Slow growth, similar products. High rivalry pushes prices and profits down.
3. Threat of substitutes. Pressure from alternatives outside the industry, like email replacing letters. High threat limits pricing power.
4. Bargaining power of buyers. How much can customers push prices down? Strong if there are few buyers or products aren't unique. Squeezes margins.
5. Bargaining power of suppliers. How much can suppliers of inputs, materials, labor raise their prices? Strong suppliers take a bigger cut, hurting industry profits.
So analyzing all 5 gives you a structural view of profitability.
Exactly. You understand the underlying forces shaping competition and long-term returns in that industry. An industry with weak forces is just inherently more attractive than one facing intense pressure from all sides. It tells you a lot before you even look at a specific company.
Powerful framework. Last, industry classification by reaction to the economic cycle, cyclical, defensive, or speculative.
Yeah, this is about sensitivity to recessions and booms.
Cyclical industries feel the swings the most.
Definitely. Earnings soar in good times, plunge in bad times. Think big commodity exporters, lumber, metals, oil, tied to global demand, commodity prices. Also industrial sectors like transport, capital goods, consumer areas like autos, retail, energy, gold are cyclical too, with their own drivers.
And the U.S. cycle matters a lot for Canadian cyclicals.
Huge impact, given the trade links. A weaker Canadian dollar can help exporters too, but the U.S. economy is usually the primary driver.
Defensive industries are the opposite, more stable.
Right. Relatively stable returns. Perform better in recessions. Provide essential goods services people keep buying. Often blue-chip stocks. Top quality, strong financials, dominant positions, history of paying dividends. Think major banks, though they are sensitive to interest rates. Utilities, gas, water, power, classic defensive, but watch out for high debt, making them rate sensitive too.
And speculative industries.
Unusually high risk, uncertainty, often limited info, high failure rate. Think emerging industries before the winners emerge. But speculative can apply to any stock bid up on hype rather than fundamentals. IP growth stocks where expectations are fragile. If they falter, the price can plummet, driven more by sentiment than solid proof.
So fundamental analysis builds this incredibly detailed picture. Value, prospects, macro, industry, company profits.
It's the deep investigation approach, yeah.
Okay, let's flip entirely. Technical analysis tools. If fundamental is the why, technical is purely the what, price, and volume on a chart.
Precisely. Technical analysis looks at historical market action price, volume, time to find recurring, predictable patterns. They believe these forecast future trends. They often see fundamental data as just too complex and figure its impact is already in the price anyway. So they focus on market behavior directly.
Based on those 3 core assumptions.
Yes, quick recap. 1, everything's discounted in the price. Price is the key indicator. 2, prices move in trends that persist. Catch the trend. 3, the future repeats the past because investor psychology is repetitive.
So fundamental studies causes technical studies effects.
Right. Symptom versus the underlying condition. Interestingly, they can sometimes reach similar buy-sell conclusions, just via totally different routes. Technical is often seen as more useful for timing entry-exit. Fundamental gives the long-term investment case.
Let's look at their toolkit. Most visual is chart analysis.
Analyzing graphs of market data to project future moves. A common one is the bar chart. Shows the high, low, close for a period, day, week, whatever, often with volume bars below.
And on these charts, they look for levels and patterns, support and resistance.
Support is a price floor, where falling prices tend to stop, bounce. Demand picks up, supply dries up. Resistance is a ceiling. Rising prices stall or reverse. Selling increases, buying fades.
What if price breaks through resistance?
Often a strong bullish signal. Suggests buyers overwhelm sellers at that key level. And that old resistance level frequently becomes the new support on any pullback. Ceiling becomes floor.
They also identify chart formations or patterns, believing they reflect market psychology.
Yeah, 2 main types. Reversal patterns suggest the trend's likely changing direction. Continuation patterns suggest a pause, consolidation, before the trend resumes.
A classic reversal pattern, the head and shoulders.
Very well known. Can be a top formation signaling a peak, or an inverse one signaling a bottom. A top looks like three peaks. Shoulder, higher head, another shoulder. The neckline connects the lows between the peaks.
And the signal is a breakout.
Exactly. For a head and shoulders top, the confirmation is price breaking decisively below the neckline, ideally on increased volume. Suggests sellers took control. Trend reversing down. For an inverse bottom, it's breaking above the neckline on volume. Buyers in control. Trend reversing up.
And a continuation pattern example, the symmetrical triangle.
Shows volatility shrinking. Price moves sideways, range gets tighter, forming a triangle. Represents indecision, consolidation. Usually a pause before the trend continues, but can be a reversal. The key is the direction of the breakout. Upwards break suggests uptrend continues or reverses up. Downwards break suggests downtrend continues or reverses down.
Beyond charts, there's quantitative analysis, stats and computers.
Using statistical tools on price volume data, often automated. A very common one is the moving average, MA.
How does that work?
Averages closing prices over a set period 5 days, 40 weeks, 200 days. As new data comes in, the oldest drops off. Creates a smooth line on the chart, filters out noise, shows the underlying trend. The 200-day MA is a big one for a long-term trend.
What signals do they get? Crossovers.
Yeah. Trend was down, MA line above price. A buy signal happens if price breaks above the MA line, especially on heavy volume, and the MA line itself starts rising. Suggests downtrend might be ending.
And the sell signal?
Trend was up, MA below price. Sell signal if price breaks below the MA line, again, ideally on volume, and the MA line starts falling. Signals potential weakness, trend reversing down.
They also use sentiment indicators, measuring investor mood.
Exactly. Tools to gauge overall expectations. Could be surveys, bullish versus bearish investors, or option ratios, puts versus calls.
This is where contrarian investors fit in, going against the crowd.
Yes. They use sentiment to gauge the majority view and potentially bet the other way. Logic. If everyone's super bullish, who's left to buy? Buying power might be exhausted. Potential peak. Extreme bearishness. Maybe everyone who wanted to sell already did. Selling pressure exhausted. Potential bottom.
But it's supporting evidence, not the main signal.
Usually, yes. Best used to confirm signals from other technical tools. Like if 80% are bullish and you see a topping chart pattern, a contrarian sees stronger evidence for a potential sell.
Okay, last tool area, cycle analysis. Forecasting when things might happen.
Tries to predict timing of major moves, peaks, troughs. Based on the theory that market prices follow cyclical forces, repeating over different time frames, days to decades.
But the source lists categories: long-term, 2 years, seasonal, 1 hour, primary, 9 to 26 weeks, trading, 4 weights.
Right. The tricky part, multiple cycles operate at once, influencing each other. Cycle analysis mainly helps identify time windows for expected turns.
Not a precise timing tool on its own.
Needs to be supplemented with other tools, trend analysis, chart patterns to confirm a turn is actually happening within that window and guide specific actions. Helps with the when, but you need other tools for the what's happening right now.
Wow. Okay, that was definitely a deep dive into 2 very different toolkits.
It really highlights the contrast. Fundamental analysis trying to nail down intrinsic value through deep economic and business research.
While technical analysis is all about reading the market's mind, its psychology, through price and volume patterns, looking for directional clues.
Exactly. Both aiming to predict prices, but from such different perspectives, using completely different data.
And hopefully this gives you listening a much clearer picture of these structured approaches analysts use, how they try to grapple with all that information and form opinions. It's not random guessing.
Definitely involves distinct methodologies.
So wrapping up, what does this all mean for you? Thinking about investing or just understanding markets. We talked about EMH, if markets are efficient. Does detailed analysis even matter?
But then there are those potential inefficiencies, information gaps, psychology. If they do exist, how could you spot them? And maybe there's value in combining approaches. Fundamental long-term view, technical timing.
Something to think about. Which approach makes more sense to you? Or how could using both lenses maybe give a richer picture? How does understanding these different ways of looking at value versus market action change how you might view a securities price next time?